Hello, it is June 16th, 2021. This is As the World Burns. I'm your host, Randall Burns. Today, our topic is diversification and Ray Dalio's all-weather portfolio. Now, a very traditional portfolio is the 60-40 stock bond split. Ben Graham talks about that in The Intelligent Investor. Warren Buffett has talked about that also. The basic point of that split in part is to be able to take advantage of downturns in the stock market. Ray Dalio's all-weather portfolio is a little different. It's 40% stocks, a stock index fund. He uses the S&P 500 index. 55% bonds, 7.5% gold, and 7.5% commodities. Now, I will include some analysis that's been done by others on the stability of this portfolio and its real returns over time. It has some real data behind it. Okay. And, it has a real pedigree coming from Ray Dalio, the manager of the largest hedge fund in the United States, if not the world. But there's some issues here. One is, what really is optimal diversification, and is there a theoretical basis for it? Now, the thing that bothers me about relying on US dollar bond funds and the S&P 500 index is you're making a real big bet on the United States. And there's, as I will go into in a little bit more detail a little further down the road, it's not obvious to me that the United States is going to keep up with the world market. And just from a standpoint of, if we were going to go for diversification, it seems to me that diversification really ought to be global. Now, as far as the theoretical basis goes, I would say maybe we want to keep our assets in proportion to global wealth. I mean, that would be a theoretical basis. That is betting the market globally. And I have a link that I'm including in the description from the Visual Capitalist that did an inventory on much of the world's wealth. Okay, that's from the Visual Capitalist. And one of the things that comes out on that that's really interesting, that's actually surprising, I think is going to be surprising for a lot of people, is how much of the world's wealth is real estate and how much of it is tied up in bonds. Now, the bond aspect, I think, is tricky because a lot of the bonds are not held by individual investors. I need to get a better source on this, but from what I've been able to glean so far, only about a quarter of the world's bonds are actually held by individual investors directly. The rest are held by banks and insurance companies. Government agencies actually hold a lot of government bonds for various reasons. So when you cut away the slack and you look at what is held by individual investors, I think it's about a quarter. So I would take the figures in the Visual Capitalist a little differently. I'd look at them a little bit differently when doing a cross-section of global wealth. Another broadly held asset that was ignored is art and collectibles. And I'll include some links on this one. There are actually companies now that sell an index in blue chip art. I mean, basically, you take 100 of the greatest artists of the last few hundred years, and they put it together. Now, what I find interesting in their blue chip index is they leave out some of my favorites like Van Gogh and Da Vinci. Okay, but they do include Salvador Dali and Andy Warhol. I mean, they do include a lot of really interesting artists in there. And this is not something that would be a huge aspect of the portfolio, but the art and collectible market is 3 times that of the crypto market that they do include. So I think it deserves mention. Now, the funds that I like for providing international diversification, and I will put links into them below. They include VSS, which is a international stock index excluding the United States, BNDX, which is International Bond Fund, REMX, which is a strategic metal index, which I think could complement Ray Dalio's use of the GSG fund in his portfolio. For gold, I don't like the gold trust or the or holding gold directly, except in small quantities, like in your home. GDX and gold are two funds that are fairly safe. Gold is Barrick Gold, which is a single stock, but they hold mines. They hold mines all over the world, and they pay like 1%, 1.5% dividend typically. And so you basically and their price varies pretty directly with the price of gold. A lot of their gold stores are gold that hasn't been refined yet, but it's established that it's there, and it can be mined at a fairly reasonable cost, and so they mine it as they want to. GDX is a ETF that holds a variety of gold mining stocks. That's what I'm holding personally, and I'm actually buying this month. There's another thing about, one of the other tricks on this is gold is fairly seasonal, so you buy it during the season, and that's how I'm managing that aspect of my portfolio. I'm putting about 75% of my holdings in something, I got my modified all-weather portfolio. And I'm also holding a bit more crypto than is warranted by the global percentage, just because that's something I understand. And in particular, I think that I like Ethereum because it's been created from the start to be something that can be used to trade prediction markets easily. And I think that has a lot of ramifications down the road that Bitcoin doesn't have. But I'm still sorting this out in my own mind. Two of the ways that we can compare this, the article that I linked to that looks at the all-weather portfolio looks at historical returns fairly well. And they also, there's another one that includes historical returns with varying degrees of leverage, with, of course, which have more risk. But there's also the aspect of historical volatility. I mean, part of the point of the all-weather portfolio is to minimize volatility. And I'd like to see how that relates to a globally diversified portfolio versus a U.S.-centric portfolio. And my guess is that the last 80 years are not that great of an indication, just because of the position the U.S. had up until the mid-60s, it was literally the only intact economy after World War II. But there are some questions on Metaculus that I'm including in the description that relate to what we can expect from the U.S. Okay, we can't expect the dollar to be as dominant in international reserve currency as it's been. That's according to a Metaculus question that I wrote. There are real reasons to expect that the U.S. will have more political instability the next 10 years. It's just the way it is. So I think in that context, and I think in that context and in the context of many U.S. investors, because, for example, like I hold Social Security, I hold a insurance policy that's fairly valuable, that's dollar-based. So I'm kind of married to dollar assets in that way. And so I like holding non-dollar assets, even in relatively small amounts. It makes me feel more secure. Okay. And in the book, The Psychology of the Money, they describe the things that generations go through that create their mindset on money. I lived through the Nixon inflation. I saw what oil lines were really like. during that kind of disturbance. I saw what the Midwest farm crisis was like. I saw what it was like for those of us that had that were skilled tech workers that were impacted by the H-1B expansion in the late 90s. And I like having assets that don't have a lot to do with the people that made those decisions. It just makes me feel a little bit more secure. So it's my money and I can do with it as I want. But the thing is that you need to look at your individual assets, your real estate, your Social Security, your insurance, and look at those as an asset and blend those with the global wealth information to create something that gives you a balanced portfolio. And that's really the thing I'm trying to communicate here. Now, in my case, most of my assets are in real estate. They're in a very particular type of real estate. I mean, specifically, it's ex-urban timberland. And the timber value of this property is substantial, but it's also on the edge of commuting distance to the Portland metro area and to the Portland airport. And in fact, as I said in my Tesla and real estate video, this is a property that I think is going to become more valuable if Tesla can achieve any of the goals they're shooting for. But it has a little different market profile compared to urban real estate, suburban real estate, and farmland. And so, I would like to, hold probably through REITs, some of those just to round up my portfolio a bit down the road. And this is kind of my thoughts on this right now. I'd love to hear yours. And thank you very much for joining me today. I really appreciate your being here. This is As the World Burns signing off. See you again soon. You take care.